let's walk through Allstate's financials here and maybe see if we can't get some sense of what's in the annual blank. I know it's a little bit tedious to go through all of it. I'll probably have to switch back and forth between the two because it's a little bit blurry when I copied it over. So I'll kind of be jumping back and forth. But the first page is the jurat page, what they call the jurat page, and it identifies a company. There's some pretty good information in here. You even have some contact information if you want to try to email or call someone about a job. They don't have actuary information here or finance, but they do have the chief accountant and their phone number and email and all of that. So, it might be worth a cold call. So there's the email. Alma Lopez, probably an accountant, probably in their home state of Illinois. But it gives you information where they're located. Every company has a NIC company code, so the regulators give them a company code, a group code. So all Allstate companies have the group code of 8, which is a fairly low number. So one of the first insurance companies out there. And this is their statement for 2019. So because it's already April, we were able to get 2019. These are usually filed February, March, and again, they're filed electronically with the NAIC. So there is a database that has all these in there, but they put it on their website. It tells you all of the officers and the directors and trustees. Everyone's signing. At the bottom, there's another signature. They don't have this in here. I don't know why it's not part of this group of papers. For some reason, they don't put it in there. But there's another page that the chief actuary signs stating his or her confidence with the reserves and actuarial valuations, and that's a separate document, but it's not in here. Then you get into the financials. So the first page is assets. And we'll talk investments with insurance companies in our next class, but you'll notice that the largest asset on their books in the entire balance sheet is bonds, and that's true. It's more true for life insurance companies. You'll notice that common stocks is a huge number, $10 billion, whereas bonds is $28 billion. This $10 billion is a little bit misstated because it includes subsidiaries, so their investment in Allstate life insurance companies in that number. But insurance companies, life insurance companies, it's almost all bonds, and if you see any stocks in a life insurance company, it's probably 100% subsidiaries. Life insurance companies do not buy stocks. But property and casualty companies do buy stocks. We'll talk about that. Why do they buy stocks? Mortgage loans is pretty unlikely in a property and casualty company. What could be a major item in a life insurance company. Real estate tends to be a fairly small number, except for the home office. So their main operating building that is $202 million. If you saw this on USA's books, I think their number is like $500 million. But this might just be the building for Allstate Property and Casualty Company, and maybe the life insurance company has another building. It was interesting, USA has several buildings, and they had one building for their bank that they kept moving back and forth between the bank and the property and casualty company. I think every 3 or 4 years they would contribute the bank building down to the bank, and then a few years later it'd be a dividend back up. So this number may not be the total value of all of Allstate's property that they occupy. Cash is a pretty small number. There's cash. Cash is a fairly small number. I mean, it's a lot of this cash is probably just bonds that are maturing within a certain amount of time. Other invested assets, that's a fairly significant number. You notice their total investments is $47 billion. $6 billion of that, so 13-14% is other invested assets. There's a schedule called Schedule B. We'll talk about Schedule A, B, BA, D, which lists, and it's amazing, it lists every single one of these other invested assets in absolute detail. Every single asset is listed. I use this information to figure out exactly what Allstate was investing in, so I could compare USA to Allstate and State Farm. Allstate has more Schedule B assets than most insurance companies. They're pretty heavy there. They do a lot of derivatives, and they have some private equity and those type of things. So that's what's in the other. So that's $46 billion. If you go to the very bottom, which is the total for assets, it's $54 billion. So $46 $7 billion of their $54 billion in assets are investments. True, some of that is home office and some of it's subsidiaries, so it's a little overstated, but still the bulk of their assets are investments. Then once you get past that, you notice most of their assets, they have a couple of big assets related to premiums. We talked about that, uncollected premiums, deferred premiums. Those are bizarre accounts we're not going to talk about, but that's the bulk of their other assets. The rest of it are just typical kind of some accounts receivable, and there's probably some related to the reinsurance. And then they have furniture and equipment. $310 million. Not a lot of furniture equipment. And what you'll notice with furniture and equipment is they actually subtracted all. This column is called non-emitted assets. This is only statutory. There's no such thing as this in GAAP accounting. And for property, plant, and equipment, or just equipment, not property, but equipment, they subtract 100% of it out. They actually don't allow insurance companies to show that they own any buildings or tables or computers. They completely subtract that out. So here's the computer equipment up here. I guess they have a little bit of a computer equipment that they allow that's not emitted, 93 million, but none of the tables, chairs, trucks, anything that along those lines are allowed here. Now their buildings that they occupy is up here in assets, and that is allowed. That's a fairly unique item for insurance companies, both property, casualty, and life insurance. Then you have your liabilities, and the key here is to look at their reserves. Their loss reserve is $14 billion. Their loss adjustment reserves is $4 billion. And then their unearned premium reserve is $11 billion. If you look at that, 14, 18, $29 billion of their $33 billion in liabilities is reserves. So you can see the actuaries drive their reserves. I mean, drive their liabilities. That's the most important thing. You see a little bit of other types of premium related. You have some expense related, just typical accrued expenses. This payable for securities is a very unique Allstate thing. They do securities lending. And so that's related to that. USA does that as well, but they don't record it the same way. But payables for securities, that just means that they bought some bonds and they own the bonds, but they haven't done the wire transfer yet. So that's just something, just a few days difference. There are some unusual accounts in here. I think this one line 15 is pretty unique. Remittances not in items not allocated. The fear an insurance company has is that someone mails them a check and the insurance company doesn't want to take on that risk, but they cash the check, and now suddenly, because some horrible driver mailed in a check for $500 and Allstate cashes it, now the driver says, hey, I have insurance, I just had a wreck. What the states allow companies to do, because they're processing thousands and thousands of checks a day. I mean, USA would process 200,000, 300,000, 400,000 checks in a day. There's no way they can check, make sure every check is for a customer that they want to take risk for. So what the regulators say is, if your system cannot identify who that money is from, you're allowed to go ahead and batch that check with the other checks, cash it, and then if you discover, and while you're waiting to figure out whose money it is, you put it in this remittance and other items not allocated. It's not a big number, but it's an important number from the standpoint of insurance companies do not want to take on risks that they didn't agree to. So they have a chance to cash the check. If they decide it's a person that they don't want insured, it's someone that they've canceled or someone they don't know anything about, then they just send that money back to them, and they have no liability even if that person has an accident. There's another line I'm trying to find it here real quickly. Yeah, I don't see it, but there should be a line for just regular old debt. Here it is, line 8, borrowed money from a lot of insurance companies at 0. And that gets back to what I was talking about with the holding company. Allstate probably does borrow money, but they probably borrow it through their holding company. They don't borrow it in their insurance company because it's just not a good way to do business. You don't want to borrow money through a regulated entity. And so there's their liabilities, and then you have all their net worth accounts. You'll notice there's a lot of things here, but it's fairly typical from what you would expect from a GAAP financial statement. So their net worth is $19 billion, and so there's their total assets. They have other detailed items of stuff that they write in. That's just fairly typical. You know, I look to see if there's anything major in there, and they're pretty small items for a firm that has $52 billion in assets. So there's their balance sheet, and with their balance sheet, the key is that investments dominate the assets and reserves dominate the liabilities. Pretty straightforward. The income statement, just like I said, premiums are way up here and investment income's way down here. On the life insurance, it's not quite like that. Life insurance, you have premiums and then investment income right together. So all your income is together. But for property and casualty, they do show premiums. Then they do losses, LAE, underwriting expenses, other things. So they have that underwriting gain. Remember, if your combined ratio is less than 1, then you have an underwriting gain. If your combined ratio is greater than 1, then you have an underwriting loss. And so you can see that they had $32 billion in premiums and had a $2.2 billion underwriting gain, which looks fairly significant versus last year. And then there's their investment income, and including realized gains and losses. And so there's their net income before expenses and those type of things. And then you have kind of net, kind of pretty, well, not expenses, but taxes and a few other minor, nothing major other than federal income tax. You can pay dividends. Most property and casualty companies, the dividend part is pretty small. I know USAA pays dividends. USAA is fairly unique in that they had something called subscriber savings accounts. They also pay dividends on their auto, so that might go through there. I know some of y'all are doing your paper on COVID-19 and its impact on insurance companies. There are insurance companies returning premiums because there's so few people driving. I'm hoping you that are doing that paper on COVID-19 will talk about that in your paper because it's pretty significant. USAA had an article saying they were paying back over $500 million because their claims have been so low because no one's driving. I think that would probably go through dividends for policyholders. It's hard to say. It's a tax-free, so when an insurance company pays you a dividend as a policyholder, it's not a taxable event. They're essentially returning some of your premiums to you. So there's the income statement, and then you have your essentially your net worth, your owner's equity statement. A lot of things in here, stuff that you don't normally see in a GAAP. There's that non-admitted assets we talked about, and there's a few other things, but nothing major. Net income's the biggest item that's in there. And then dividends, they do pay dividends to their stockholders, and that's a significant item. But most of the other things are fairly small. You do have unrealized gains and losses on your investments, and so that can be large if a firm has a lot in stocks. You know, this year you'd expect that to be a negative number for 2020 if the stock market stays down the rest of the year. The cash flow statement, not much here. We don't use the cash flow statement much with insurance companies and banks. It doesn't tell you much. It really doesn't, because there's really not a concept of free cash flow for an insurance company, because yeah, they got all this cash, but they're also insuring people. So this is really not free cash flow that you can do anything with you like. This is really float. As we talked about float, this is money that they're probably going to have to pay out in the future in claims. So it's not a good number to look at. And what you'll notice on the cash flow statement is that the biggest numbers are under the investing side. They're buying and selling investments constantly, and they're huge numbers. And there's not much on the financing side, because if you remember what Warren Buffett said, they like to essentially borrow money from their policyholders through premiums, because that's a cheap way to borrow money. So there's not a whole lot there. And there's some overflow pages. And then there's some exhibits, and I won't go through all these exhibits. I gave you one of them. But what I love about this exhibit, the reason I gave you one, is it gives you a breakout of all their products. So you can see fire. What's the difference between fire and homeowners? I had that explained to me once. It's a small item for most companies. One of the alums from this class that took this class several years ago, he was an actuary. I think he still is an actuary at USAA, and his product was fire. So people who have a structure, I'm trying to remember how I explained it to you, have a structure, but they don't own homeowners insurance, but they do want to be covered just for fire, they can buy this special type of policy. You have farmers, you can see they don't do farmers. Homeowners is a huge product for them, so you can get a sense of where they're selling their business. The earthquake is a large one. Obviously, auto insurance is huge for Allstate. They're the second largest auto insurer in the country. The last time I looked, they had about 10-11% of the market, so they're a huge writer. But you get a good sense of what they do. So if you're interviewing with a company, that's why I say this is so important. you can look at Allstate and see you got 8 billion, 12 billion, 10 billion. That's 95% of their business is homeowners and auto, and they break up auto between liability and physical damage. So it's really all one product. Remember we said Part A is the liability and Part D is the physical damage. So they just break it in those two pieces, and that's that's 21 billion out of their 32 billion. So 2/3 of their business is auto insurance. And there's several more statements where they just give you more information, breaking down in detail. Really nothing. There's written premiums, earned premiums. You can see how they make a big deal in distinguishing between the different types of premiums. And then here, what they get into is the investment side. And on the investment side, I'm sorry, this is this is losses. We're still in the detail. Yeah, it's just going through detail after detail for every product line. A lot of information here. All right, so they have a page on expenses. You want to know where all their expenses are. They have a page that shows you that. So you might look, it's really nothing too amazing here other than the premium tax. The premium tax should be part of the taxes. I don't see premium taxes sticking out to me, but it's up here somewhere. But anyway, that would be a huge line. Yeah, sorry, I can't see that line. But so some information there. Then you get into some investment schedules. The investment income schedule essentially just shows you where their income from investments come from, including here they actually have affiliated common stock is broken out, and you can notice that for them the affiliated common stock is 324 million versus only 90 million for their other stocks. So the bulk of their stocks is actually affiliated companies. And then they show, oops, sorry. I don't know why someone kicked me over to Facebook there. And then they show capital gains at the bottom. Here's the non-emitted assets. You want to see they come from. The bulk of them, again, are the electronic equipment and the furnishing equipment. There's a few others that aren't that important. And then what you'll notice, and I didn't print this out in the PDF I gave you, notes of the financials, and they go on forever. This is page 14. If I go down to page 50, you're still going, page 14. I can't tell you that reading this for a company would help you for an interview. It might be a little overkill, but just page after page after page. And then after the notes of the financial, then you have the interrogatories. And there are pages and pages of this. These interrogatory are specific questions that the states require them to answer. Whereas the footnotes, the company writes whatever it wants to there, just like any footnotes to financials. But the interrogatories, there may be some stuff here. You might glance through this if you're interviewing for the company to see if there's something there. I just can't tell you. It's been so long since I prepared financials. I should go through these one of these days and just see if there's something really useful there. But they go on for pages and pages. So you can see probably 100 pages of this. And look at this incredible detail that they provide. Interrogatories just keep going on and on and on. So, all right. So I'm going to stop there, and what I'm going to do next time is we'll start on the 5-year historical data. I really love these 2 pages. We're almost through the accounting, so if you don't like the accounting part, we're almost through. There's a few more things I want to show you, especially Schedule T and Schedule Y, I think are really interesting. But I want you to be aware of the 5-year historical because it's a quick way, if you're interviewing with a firm, to go and see 5 years worth of data all at once. So we'll do that, start there next class, and then finish up, and then we'll get into what is one of my favorite topics. So there's not a whole lot we can do in detail, but it's talking about the investments of P&C companies and how their investment strategy works.